Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about capital allocation, and that's just a fancy way of saying what are you going to do with your profit? And I guess the first observation is that free cash flow isn't always there for you to spend. Certainly not spend on lifestyle. Lifestyle inflation is, something that is quite insidious in that, when we first start a business, particularly if it was starting from scratch, maybe cash flow is pretty tight at that stage, and that obviously impacts our standard of living. But then as the business grows and hopefully the profitability grows and the founder or owner's position is, from a cash flow perspective, greatly improved, quite often what we see is a lot of that lifestyle creep or lifestyle inflation, whatever you want to call it. And, if it's things like holidays, I think holidays are one of those expenses where we think really carefully about them and we get a lot of utility from holidays. So in terms of enjoyment per dollar, I don't want to sound like a really accounting nerd person here, but the amount of enjoyment we get per dollar tends to be quite high. So they're quite good things to do. But lifestyle creep in other categories typically doesn't always result in the same sort of level of enjoyment. So if we're just buying more stuff, for example, that can feel great when we buy the stuff, but we'll quickly forget about it. And it's very easy, if you're not managing cash flow well, to really spend maybe $50,000 or more on just stuff and things that actually, in reality, if they disappeared, it wouldn't be such a big issue. So that's the first observation, I guess, that Mena and I want to talk about and walk you through as business owners. The other thing as well is cash doesn't always equal freedom. So that is, if my free cash flow is $50,000 a month, doesn't necessarily mean I can go and spend $50,000 a month. There might be, capital that I need to reinvest in the business, for instance. I obviously need to think about taxation obligations. If my business has commitments like debt and those sorts of things, I want to start thinking about how do I want to manage those things? That is, do I want to put some of that cash flow towards debt repayment? And then, of course, investing. So, of course, you're trying to build value within the business itself. And maybe one day someone's going to come along and offer you a really big check for that business. But you want to also invest or build a pool of assets that are entirely separate from the business that creates financial security for something you fall back upon. So that's what we want to talk about today. What are you really doing with your cash flow? What are the common mistakes? And help you really think carefully about it.
So one of the biggest mistakes that a lot of founders or business owners do is that they don't separate personal sort of reward or business cash from their personal cash flow. There's a common misconception that basically if there's profit in the business or excess cash in the business, then that belongs to the owners, right? However, what you got to understand is that the business is actually a separate legal owner or entity to yourself. So what the business has, it's legally entitled to have. It's not yours until you've actually paid it out in the form of a wage or a dividend or a distribution of some sort. So founders get blurred with that sort of idea is that, well, it's there, it's accessible. Why can't I use it? Well, there's certain tax consequences as a result. So a lot of people get caught up with these Division 7A loans, for example, which you would have heard us talk a lot on this podcast about. It's because they've used the funds of the company or the business for their own personal use. And then they haven't actually declared a dividend or a distribution or wage to offset that loan. And this can create a lot of tax drag in a business. What ends up happening is the owners year end, when they come to do their returns, they realize they've got a massive tax bill to deal with. So it's really important to position yourself in a way that you can actually not unblur those lines between the business funds and your funds. Now, when the business has a lot of cash flow, a lot of us, like Stuart mentioned about lifestyle inflation, we all get caught up with the shiny objects. We all want, the nice homes, the fancy cars, and, the travel, the meals, and so forth. But it's really important to have discipline around how those funds are actually going to be used.
That's right, Mena. I remember reading this story about Warren Buffett or something, and his wife wanted to go and buy a new couch, and he sat back and worked out, well, if he had invested that money, instead of buying the couch, invest the money in an S&P 500 index fund, and in 30 years, this is what that amount of money would be worth. And he sort of told his wife, the couch is actually going to cost us, opportunity cost wise, maybe $100,000 or something along those lines. Anyway, it's an entertaining story. I'm not sure I would take the same approach if my wife wanted a new couch, but it does highlight we need to think about opportunity cost. And one of the things that businesses sometimes need is cash. Cash is the lifeblood of a business, of course. And if the founder or owner of a business is spending all that money on themselves, on lifestyle or whatever it might be, sometimes depriving a business of the reinvestment of cash flow can come at a very big opportunity cost. So I think that's the first thing that business owners should start really thinking clearly about is how much cash do I want to pull out of the business versus how much cash do I want to keep in the business? And what could I do with that cash? Could I hire a consultant to come up with a better distribution or marketing strategy for my business? And maybe if I invest $50,000 in a project, can that increase the capacity or turnover of the business or profitability? So it's not about inventing things to spend money on, because that's also can be a problem as well. I'm not suggesting that people should be reinvesting all their profit in their business either, because that can be a problem as well. We come across a lot of business owners that have been in business for a long time and, they've invested heavily within their business, whether it's plant equipment or growing the business and so forth. And really all their wealth is tied up in that business. So that's not ideal either. But going completely the other direction, as I said, spending all the profit and starving the business of capital investment is not good either. It's really about sitting down and having a bit of a plan. And probably the best thing that you can ask yourself is, how could I spend some of this profit, invest some of this profit in my business so it makes my business stronger 2 to 3 years from now? And that time horizon is kind of good because it helps you put some context and numbers around expenditure. And so maybe hiring another person just a little bit earlier than what you might expected, for example, comes at a cost, of course, higher ongoing costs, but it might help you with your growth plans. And I guess what we're trying to do here is reduce dependency. Ultimately, we want a business that thrives and grows, that doesn't necessarily just rely on us coming to work and doing all the work to generate that growth.
Yeah, I guess that's really the question, Stuart, as you got to really decide what type of business you're building. What type of business do you want? Are you sort of angling for a business that sort of just pays you sort of a high income salary? Or is it a lifestyle business, a business that you just want to extract every single dollar and enjoy your life? Or a business that you're really sort of trying to create for a liquidation of down the track? So an enterprise value business is what we call it. So it's really important to sort of understand why you're in business and put some sort of cash allocation policies in place. Now, there's nothing wrong with either type of those businesses. Everyone's in business for different reasons. But what founders really want is to sort of establish some sort of freedom or independent sort of way of living away from sort of working for someone else. So you need to have an honest sort of discussion with yourself as to what you're really trying to achieve from your business, and then create a hierarchy of obligations in terms of your capital allocation. So once you've established what type of business you are, okay, say I'm creating the enterprise value business, then I know that I need to have an allocation for my tax obligations. I need to have an allocation for my day-to-day working capital for 3 to 6 months. I need to know how much I'm actually going to get rewarded for the work that I do in the business, and how much I need to reinvest in the business so I can actually get some freedom within the business down the track. And then talk about personal distributions. How do I actually divest away from my main nest egg? So all these are the types of questions that you need to be asking yourself as a small business owner as to how and what am I going to be using my money for? And then there needs to be some sort of ownership or onus on you to keep yourself accountable, or have a handful of people that can keep yourself accountable. So put some budgets in place. If you're using something along the lines of Xero or another sort of software, a lot of these actually have inbuilt budget and forecasting tools that can help you ensure that you are actually meeting these targets. And this then helps you reinvest further in your business.
That's right, Mina. So let's talk about a bit of a hierarchy and priority of sort of cash flows. So I think the best thing to do is really do it periodically, but I like to at least do it annually. Really think about, okay, what is my budget? What profit do I expect to make? Now, the first thing obviously we need to allocate for is taxation. That's obviously we need to make sure that we meet those obligations. So they're very important. The next two buckets, if you like, that we can allocate cash flow to is really investing. investing inside or outside of our business. So that's 1 and 2. I like to really employ the idea you pay yourself first. So that is, do the most important things first, invest first and spend what's left over. So that's why I'm putting investment as 2 and 3, because tax obviously is 1. So investing in your business, that really comes back to some of the things that we've just spoken about and we'll speak about for the rest of this podcast, which is really, okay, what do I want to allocate towards reinvesting in business? And again, the idea is not just to find things. It's to be obviously linked to your business plan. There's got to be a good payback or relatively short payback period. Depending on what the answer to that is, then you move to the next one, which is investing outside the business. Investing is a discipline, and investing or building wealth outside of your business, it's really about a commitment to regularly investing. So you can break that down perhaps into a monthly figure. So the first 3, it's tax, investing in your business, investing outside of your business. And then the final one is money left over to spend, which, you could put towards either saving or, expanding your standard of living, if you like. That's probably the best way to sort of put it. And it's best to think about and allocate those percentages up front. And that way, if you have a better year, for example, if you beat your budget on a profit perspective and you want to allocate, the amount that you beat the budget to, upgrading your holiday, for instance, you can do that guilt-free, knowing that you've already thought very carefully about how much needs to be invested in the business and how much you need to invest outside of the business to build personal wealth. And it allows you to do that on a sort of guilt-free basis. So I do this personally every year, and it's something that you need to revisit. Also, if your actual versus budget changes through the year, of course, there's nothing that doesn't stop you coming back and juggling those numbers around. So for instance, if, your profit is lower than you expect, then okay, you might sort of shave off some of the investing or curtail some lifestyle expenses. But if it's much better than what you expect, the reverse is true as well. And if we don't take that really deliberate approach, as in asking ourselves, okay, what am I going to do with my profit over the next 12 months? Sometimes it can leak and people think, oh, look, I'll get to that. I don't really know what to do now. And before they know it, the money's gone because they're spent on lifestyle expenses. Isn't that right, Mena?
Definitely true, Stuart. How many people, how many businesses we've come across where the business owners are all about sort of visible success rather than real wealth. And what I mean by visible success is it's all about status for them or egos. So it's all about, the cars that they drive or the offices that they're in. They've got a sort of a clean sort of CBD large office that's got all the bells and whistles, or, they're traveling, every 6 months to a European holiday. And what we find, and we've come across this with some of our clients and, in the broader market and even in the news, there's, an article about someone going into liquidation every sort of month or two, because all they're focused on is basically all the shiny objects. So it's really important to go back to what I mentioned before. It's really important to sort of divest, to understand what those cash allocation policies are and how do you divest away from your business? How do you divest away from your nest egg in a way that allows you to actually have those shiny objects, but maybe just at a later date? So going back to the couch example from Warren Buffett, is that I think he still drives is it the Cadillac or the Lincoln that he still drives now, that he drove from the 1980s, still has his standard Coke a day, because he hasn't experienced lifestyle inflation. He's just always had a good cash allocation policy, never let his ego get in the way, and he always just reinvested in his business.
Yeah, but I think a nice car is good to have as well, Mina. And also it's important that we're well rewarded for the risk and energy and effort that we put into our businesses. So, I'm not contradicting what Mina's saying, because I think it's really important to think very carefully about cash flow allocation. But also we want to sit back and go, well, are we being rewarded? How much risk is involved in the business? How much capital have I got invested in it? And what is the return on that capital? What is the return on my effort? If I work out in terms of how many hours I work and I work out my hourly rate, for some people in businesses that aren't necessarily going so well, they're getting a very low, they're probably earning less than the minimum wage if you work out it on an hourly rate. So we're not suggesting that, you're not fairly rewarded for either as an employee of the business, someone that's working, a working owner in the business, or as an investor in the business, being, you're holding the equity and capital for that business. So you need to be fairly rewarded, and that's really important too. Similarly, we find is, people might take drawings out of a business and they sort of, that's their quasi wage, which is fine. It can be appropriate for an owner not to be paid a wage, particularly if it's going to give rise to higher work cover, payroll tax, these sorts of things. But the problem with not taking a wage is that, maybe actually I'll put it a different way. The benefit of taking a wage is that you're forced to make personal investments through superannuation contributions. And whilst that can be a negative, like owners of business might go, well, that's actually harming my cash flow. It's true, but it is a forced investment. And that's part of the problem, that if business owners take drawings out of a business, they can avoid making super contributions as a result. And whilst that might be good from year to year, depending on cash flow situation, over the long run, it's not so good. And we typically see self-employed people with lower superannuation balances than, say, people of a similar age if they're PAYG. So being fairly rewarded, paying yourself a salary is, again, whether you structure it as a salary or drawings, is going to depend on your situation, but being fairly rewarded is really important. So really today, what we wanted to really just impart is to think really carefully about profit allocation, to make sure that you're not starving your business of any capital improvements, and think about the opportunity costs, to make sure that you're thinking carefully about building wealth separate to your business, personal wealth that you can fall back on. If one day you wake up, your industry or your business or your sector or your product, whatever it is, has changed considerably, you don't want to be single point sensitive on that. And being deliberate about lifestyle inflation. It's not about avoiding inflation. It's not about repeating Warren Buffett's approach and driving an old car for the rest of your life, but it's really about making very conscious decisions about cash flow management. Okay, we'll leave it there. Until next week. Bye for now.